Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. The ratio says it all. You hit that 50% resistance of that secondary downtrend last week. We covered that, and boom, that was resistance enough to turn that guy. You shift it. Your shorter term time frames lower, the 5 and 10 day. From a day trader's perspective, you're back to selling rallies. It could be tough sledding going forward if you don't see some support hold in here around 71 even. The 800-pound gorilla in the room is going to be the FOMC decision next week, next Wednesday. So we'll see what happens there. And that's a large enough event on the calendar. That would be the potential for the U.S. to raise interest rates for the first time in a long time, first time in 9 years. That'll put traders on hold. That'll certainly put directional traders on hold. It looks like you're going into a holding pattern in the Aussie right now. Here's the dollar Swiss coming up on good support right there. We love this trade from a long-term perspective. Again, pop out on the monthly and you see how far it could move. You just had a breakout at the end of last month. Short-term patterns lower, however, and again, here's another one. You're probably back to a daily. You're probably in a holding pattern ahead of that, the FOMC news. On the other hand, longer term, if you wanted to stick your toe in the water, we think if you can get below 98 the figure, then just take a small position, very minimal position with leverage or preferably cash. Ideally, it's not the best advice to step out in front of a U.S. rate decision because that market could go either way. But on the other hand, if you know the risks and you have a small enough position, you just want to initiate that. This is the area on the in price that you want to do that area, in price and time that you probably want to do that. So we're still bulled up on this guy from a long-term perspective. We like it, and we're eyeballing this level pretty closely. It's going to be great to be doing the report a week from now and have that U.S. decision out of the way. Next market we'll look at will be the dollar index. There's the dollar index. Same story. You couldn't quite break out above the yearly highs, so you got a fizzle there. It looks like the market makers reset that market. Boy, the market makers were really on the wrong side of that, as everyone was buying dollars, everyone was selling euros. It's not often the market makers lose money, but they were in a position where they potentially could have lost money if that market would have broke out a couple weeks back. So market makers did what they do best. They reset that market. Pretty risky event for them to do that. Nonetheless, it worked for them. They're able to replenish supplies, and they're in a better position to make a market in the dollar and the euro, by the way, in a trending market now that they were able to reset that guy. And so really that's what we see, that move as a reset. And we see now, following that reset, markets pausing ahead of the U.S. news. Imagine this: if they weren't able to reset that market and the dollar broke above those highs, likewise the euro started making new lows ahead of the U.S. rate decision, then the U.S. goes ahead and raises rates, and on par, that's bullish for the dollar, bearish for the euro. Imagine the position the market makers would have been then, with them being the only ones that take the other side of that market. So this market having been reset like that, that's what we refer that to. Essentially drive that market back down through the short-term support down to longer-term support. Everyone gets stopped out, so to speak. Everyone gets flipped around there, and it gives the market makers a good position. And it's a great opportunity for the market makers to reset their own position so that they're in a position to make a market on the way up in this market. So that's what we saw there. And again, it's another market in a holding pattern ahead of the U.S. rate decision. Love it long term. Short term, just neutral. Interestingly, you're heading into the end of the year here where we wouldn't expect a lot of action anyway. So yeah, I guess that just makes the Fed rate decision loom even larger. Here's the euro, and the ratio says it all for the euro. The 5, 10, 25 day up. So we've been making hay intraday. You're buying this guy, buying dips intraday. From a day trader's perspective, a little bit longer term trader, you're loving these potential levels up here. To keep an eye at for a longer term setup, though. Again, rate decision looms large. I feel like a broken record, but that can't be stated enough. I would say similar to the Swissy, that you may take, if you see this market continue higher into the rate decision, It'd be tempting to take a very small short position in the euro. Keep in mind the risk on that, though. You can't control your risk ahead of a number like that. So, that's the concern. That's why you would not use leverage, but maybe use a very small amount of leverage, or potentially just take a smaller cash position in that, and then if that resistance hold in the market turns around like we think it probably will, then you can add to that short position on the way down. Nothing's changed for us in the euro short term. Be patient. You're probably looking at steady to higher markets from a day trader's perspective. You can take advantage of that on the intraday charts, as we taught all week. Longer term, just be patient and wait for a setup just below that 112 area to get short. Gold market. Gold's kind of holding its own. Similar story here. It's interesting. You weren't able to reverse that 25-day pattern higher. 25-day pattern still down. We still see gold as a leading indicator on the downside. You can see that really anemic rally you had, and that's all it could give you. What can you say? It's still a bear market there. Like everything else, however, we'll have to see where it's at come next Wednesday. Last market, we'll take a look at U.S. interest rates. Similar, you're in a holding pattern. You can see you're holding support. What's really bullish about this chart is these higher time frame patterns from the 25-day up, 25-day, 50-day secondary, primary. They're all up, and that's a good market to buy a dip in. And where you're at now, the market dipped. So you're dipping into that rate decision. Could be a heck of a buy opportunity setting up here in the U.S. dollar. Wager that you will see higher interest rates, essentially, that the Fed will do what they've been saying they're going to do. They either do it this time or they do it next time. I think it's inevitable that you're going to see that. Thank you so much. My name is Jay Norris. I teach at Trading University. We'll see you next week.